Hello, everyone, and welcome to the DebtCircle podcast, India's only dedicated platform for debt market. I'm 𝙬𝚒𝚘𝗔𝗓, your host for today's episode on Building India's Bond Culture. How is the retail bond market shaping up for the economy and for retail investors? For decades, bonds had remained in the background of India's investment landscape, but that's beginning to change. To discuss the evolution of bond investing and what it means for investors and the economy, we are joined by Mr. Abhijit Roy, CEO and co-founder of GoldenPi. Abhijit, welcome to the DebtCircle podcast.
Firstly, thank you for having me in this show and looking forward to a very interesting conversation today.
So let's start with the missing market. Now, for decades, Indian retail investors have gravitated towards FDs, gold, and equities. Why has the bond market remained relatively underexplored?
Great question. My personal take is that earlier, the bond market really wasn't meant for retail investors. So in the family conversations, what people used to discuss would be FDs, mutual funds, gold, right, and stocks. Bonds would never be a part of that conversation at all. And there were primarily two reasons for that. First one is that if you observe till 2015, bank FDs were offering around 8 to 9%. So that was already earning a good level of interest, and people didn't have the need to look elsewhere. People were basically happy with FDs. The second thing is that of accessibility. So for many years, bonds have been a rich man's game. What has essentially happened is the minimum ticket size of investment was 10 lakh and above, right? And the bonds were available at very special counters which were accessible only to HNIs, corporate treasuries, or institutions. So basically, this market was completely outside the investment limit of retail investors, right? But then, the good thing is the situation is no longer the same.
No, I agree. One is accessibility, second is the interest rate. And I would also say awareness. People were not even aware there's something called as bond in those years, right? Yeah. So has something fundamentally changed over the last few years?
Yeah, actually, there have been quite a few radical changes which has happened in the market in the past couple of years. So firstly is from the demand side, if you see. So what has happened is till 2015, you would have around 8 to 9% of bank FD rates. After that, the rates continuously kept coming down, and as we speak today, a traditional bank FD would give you anywhere between 6 to 6.5% returns. Bonds fill in that gap of a higher returns very well over here. That's point number one. Point number two is that there has been some structural changes in the market which SEBI has brought in, right? And that's called the online bond platform provider infrastructure, or OBPP, right? So digital bond platforms like GoldenPi have been able to build a very seamless investment experience for retail investors, through which investors today have full access to this entire market. So I think these two things have coupled up very strongly to change the way retail investors are looking at bonds from a very fresh perspective.
So these online bond platform providers will also be accessible to retail investors?
Absolutely. SEBI has designed the entire concept so that this is meant for retail investors, so that they have got access to the bond market very easily. They can explore the bonds digitally, and they can make investments in a very safe and secured way through a completely digital route.
Yeah, that will be super helpful. Yeah. So are we witnessing a genuine shift in investor behavior?
Well, yeah. I think the way investors are perceiving, bonds has changed a lot from what it was before, right? So investors are now no longer asking the questions of, okay, what are bonds essentially, especially in metros and tier 1 cities, right? The question is now, who is the issuer? What is the kind of credit rating? If these are the returns, what are the associated risks, right? And investors are more interested towards diversifying the portfolio by having bonds as an active component of their investment.
Yeah, diversification is something which now people are very keen on doing.
Right.
So why bonds and why now? So what is driving the growing interest in retail bond investing?
Like I mentioned, there have been quite a few structural changes in the market, right? One is bonds, firstly, have got a very key focus from the government, from the regulators, to be made a mainstream asset class across retail investors. If you look at the bond market of the developed nations, the bond market is even larger than the GDP size. Unfortunately, in India, we are not yet there, right? There's a huge space for growth, and bond market actually fuels an economy to push that country to being a developed nation, right? With that clear focus in mind, there have been some very fundamental changes. First is this regulation around online bond platforms. Here, what SEBI did was they put in a very streamlined infrastructure through the exchanges, right? Through which retail investors have access to the entire market, right? And they can invest digitally. Point number one. Point number two, SEBI brought down the investment limits on these bonds from what was 10 lakhs earlier to down to 10,000 or even 1,000 in certain cases, right? So clearly, the market has got democratized with these changes. And third, the entire market, the market participants, SEBI, exchanges, the online bond platforms, everybody has been working very closely together, right, to dissipate the information amongst retail investors that there is this valuable asset class and it makes all sense to include it in your portfolio.
Yeah, bringing down the threshold makes a lot of difference.
Right, right.
So how are investors using bonds differently from equities or mutual funds?
That's a great question, and I'll tell you, when I have this discussion, it starts with bonds versus FDs and it just concludes over there. But actually, this asset class can solve some financial problems or financial requirements in a normal investor's life in a very beautiful way. Three most powerful use cases of bonds that I visualize are: firstly is passive income, right? So people have got recurring expenses every month. It can be paying child's tuition fees, monthly rental, EMIs, right, and other planned expenses. By investing in bonds, investors are using the interest earned to pay for these expenses, right? And in fact, to be honest, some of these use cases are something that I also use bonds for to solve in my personal life, right? And I think the best thing over here is your interest earnings are actually paying for the expenses while the invested capital remains intact. That's first thing, right? The second point is actually using bonds for meeting certain life's goals. So what they can be. People would be aspiring for goals like, funding child's higher education, buying a house or a car, couple of years down, or maybe even, a dream holiday destination, and for that expenses need to be managed, right? And some funds need to be kept to meet these goals. People can select bonds, and that's what they are doing, which matures around the time by which you want the goals to be fulfilled, right? So that gives, a very clear-cut investment goal, right? And with a lot of peace of mind, and you have certainty in the overall process. That's the second one. And the third interesting case that we observe is short-term capital investment into bonds. What does that mean? What we see is, investors know that maybe 6 or 7 months down the line, they have an expense. It can be, a family wedding or, a business requirement or maybe, certain other thing for which they need that capital, right? Instead of keeping that capital idle for 6 or 7 months sitting in the bank account, they would deploy into bonds, and then finally, after that period, they would utilize the capital wherein they have earned the interest, right? So I think these are the top things in which people are using bonds, right? And it is adding a lot of value to one investor's life cycle. Yeah.
So making the right investment in the right proportion will help us achieve our targets and goals, what we have set.
Right.
But exiting the market, like bond, like the way we exit an equity market, you buy, you sell immediately when you need capital. So will that also be, is that very smoothly done in the bond market as well?
That's a very pertinent question in the bond market structure. And I think that goes back to the question of liquidity.
Right.
So inherently the bond market, has seen more investors than sellers, right? It has been a HTM market, or hold to maturity market. So people would use bonds, or are using bonds, to deploy their capital, earn the interest till the bond matures. But in between, if somebody needs to exit, right, there's this question of liquidity which comes in. Will I get the right buyer and at the right price, right? So that is a challenge which is there in the market. At GoldenPi, what we do is, we offer that liquidity to our investors. We buy it off into our books so that, investors are able to get the capital back and they have that liquidity advantage.
Oh, that's really very interesting. Are investors becoming more conscious about balancing risk and return?
That is, a billion-dollar question, actually. So let me put it in this way. Like any asset class, bonds also come with their own fair share of risks, right? And one of the risk markers that people use very intuitively or easily, and have been using it traditionally, has been the credit rating of the bonds, right? It starts with sovereign grade bonds, then AAA, AA, A, then BBB, right? And as you understand, as you go down the credit spectrum, the returns that you get on it becomes higher, right? So I think it's a question for the investor that what is the kind of risk I'm willing to take, and accordingly, that's the returns that I'll be able to get for myself, right?
So building India's retail bond market. How has access to bond changed for retail investors over the years?
See, in the earlier years, like I mentioned, ticket size was very high, outside the affordability of most retail investors, firstly. Secondly, the awareness was so low that people wouldn't know how to use bonds, where to buy them from, right? Even the investment process was extremely convoluted, right? Even if you had access to a counter who is selling bonds, right, the process used to be completely manual. KYC used to be completely, filling up of hundreds of pages and signing them and doing transactions which were not really regulatorily, well safeguarded for retail investors, right? So that was something which kept the bond market outside the retail investors. And of course, along with that was the fact that FDs were anyways giving good returns. So people didn't need to look elsewhere. But as we speak, right, the market is opening up massively. The bond market has grown tremendously over the past decade, right? So a decade back, it would be $300 billion in the corporate bond market size. Today, it is at $600 billion, which roughly would translate to around 53 lakh crores, right? That's the kind of size it has achieved. Retail investor participation, if I talk about it, that's the most interesting part over here, right? I think that's the biggest change that we're seeing in the market. And that is, even 3 years back, retail investors per month would invest around 200 crores, right? Today, as we speak, every month, retail investor investment across both the exchanges is close to 2,000 to 2,500 crores. That is 10 to 15x jump, right? That's been a massive growth of retail investor participation that we are seeing. Number two is the wide variety of issuers who are coming into the bond market now, right? Because of the SEBI regulatory changes, very seamless investment experience, for because of which more retail investors are participating into this market. What is happening is that, more issuers are getting the confidence to come into the bond market and raise funds via that route, right? So now you would get bonds from PSUs, banks, NBFCs, real estate companies, and a lot more other categories, even EV categories, some bonds, municipal bonds, right? And that's good for retail investors. Why? Because they can now even diversify the portfolio in the bond investment portion, right? So I think, the market has come a long way in seeing that structural change. And I think we are still at, day one in the bond market. We are still to grow 1000x more.
A long way to go.
A long way to go. Yeah.
So Abhijit, what are the barriers that still exist in the market?
There are not really barriers, but I would say, things which can be done, which can actually improve the bond market acceptance for retail investors. The first thing continues to be investor awareness, right? If you go beyond metros and tier 1 cities, right? I mean, if I speak with some people from my hometown, right, which is in Kharagpur, which is in West Bengal, right, very few people would be able to resonate with bonds as an asset class. Lack of investor awareness, right? And that needs to be solved for to make this asset, across all Indian households. Number one. Number two is basically once you have that awareness, right? Do you have the understanding of being able to pick and choose bonds which will fit your life goals, right? Which means, once again, people have to have a concerted effort into investing over here, right? Third is more number of issuers of different categories needs to come in. We have a rich collection of various industries who are participating, but more number of categories actually can come in. If you look at the developed bond markets in the West, right, almost every industry category has a participation in the bond market. That's what we would want to see here, and for that, policies needs to be changed wherein raising capital for companies becomes very easy through the bond market route, of course, while maintaining the safeguards and safety mechanisms for the investors over there.
So how important is financial literacy in this journey?
Financial literacy plays a very important role. If I don't know about something, I am scared of that asset class, right? And scare means I will never touch it. The moment I start becoming aware, right, I start becoming aware of its pros and cons, and I start generating that confidence on that particular asset class, right? I mean, this was the same thing for mutual funds, 20 years back when it started, right? And people looked at it as a new asset class. What do I do with it? What is NAV? When do I exit? Right? What is the taxation? All those questions. Today, if you see, it's a mainstream investment, thesis for every Indian household, right? That's exactly the same thing that plays out for bond or for any asset class, right? People have to know about how a bond works, right? Certain key terminologies, right? And read about the information on those bonds. And that kind of, awareness builds trust on this asset, right? And once they invest, it keeps growing. That's been our experience.
Yeah, I totally agree. The awareness and education around bond market has started recently picking up.
That's right. That's right.
So now let's talk about the bigger picture. Why does a vibrant retail bond market matter for the broader economy?
The most important thing over here is that, once again, if we take reference from the West, the bond market is one of the most dominant routes to raise capital, right? Which then a company can use, or the industry as a whole can use to grow, right? You have to grow on leverage, and that has been the scenario across all developed nations, right? Talk about US, talk about China, talk about Australia, Japan, right? It's the same scenario, right? The bond market has fueled the growth of that economy, right? For us, it's the same story that will play out, right? If we have to move from being a nation which is at around roughly $5 trillion of GDP to, a nation which is there in the top 3 or to top 1 very soon, and have that vision of Viksit Bharat actually taking into shape, right? We need to have that vibrant bond market, which is fueling the growth of the economy, the companies at large, right?
So how can deeper retail participants strengthen India's debt market?
Well, it's two sides of the same coin, Retail investors need a valuable asset class which gives returns better than whatever fixed returns they're getting in bank FDs and other asset classes, right? They're looking for that asset, right? The other side, basically, the whole industry is also looking to grow with more debt, right? Because that is the way to actually push up your turnover from, let's say, a company which is doing say 500 crores, right, a year, wants to move on to the next orbit of 1,000 crores. It needs to raise debt, right? You cannot always keep doing capital infusion in the form of equity, right? Bank loans are cumbersome, right? Now bonds over there play a very critical part. If you're able to raise funds, you're able to scale up the company, and as a whole all industry categories are able to grow, right? So more retail investors coming in essentially means two things. One, more funds from the retail pocket is getting into the economy, right? Which is fueling the growth of the companies, number one. And number two, with more retail investors participating and so more participants, the issuers coming in the market, the bond market becomes, more dynamic, more in depth, and liquidity increases. So, which is a sort of a challenge today around getting liquidity, trying to, sell your bonds before bonds mature, right? That structural problem also gets solved with that. And it becomes a very vibrant market then.
So this is all interlinked, getting more retail
Oh, yeah.
investors, which will also, lead into getting more issuers.
Right.
So this is all part of the cycle.
Correct.
So what impact this could have on capital formation and financial inclusion?
I think, for financial inclusion, definitely more retail investors, participating from the hinterlands of the country, right? That's a very important part. Today, we have the bond penetration to metros and max to max tier 1 cities, right? Dominant penetration, if we may say, right? And that still also has to grow further, right? Now, as the economy grows, right, and we collectively are able to take out the information about this valuable asset class across the country, right, until the hinterlands to the tier 3 and tier 4 cities, and the townships, people get to know about it and becomes, an asset class for which people are aware of. They're able to participate in this, right? Financial inclusion naturally, starts getting built over there, wherein even the retail investor with probably 1,000 rupees wanting to invest starts saving up, right? Like in mutual funds, you have people who are consistently investing over there as a recurring theme, right? The same thing would happen for bonds also, wherein people would put this as their monthly investment into bonds, building up a diversified portfolio, right? And financial inclusion naturally starts building over there because you're seeing people from all strata of the society participating over here, right?
Like the monthly SIPs we have for mutual funds.
That's right.
Something similar will start
That's
with the
right.
bonds.
And that will start sometime very, very,
Very
soon.
Yeah. Now, looking ahead, what does India's retail bond market look like 5 years from now?
I, personally think that we are at day one for the bond market, right? There's a interesting Chinese story which says that over there, people, plant bamboo saplings and they keep watering that, right? They keep watering it for years. It hardly shows any growth. Then one fine morning, something wonderful happens. The bamboo shoots just explode in height and starts touching the sky, right? I think we are just going to see that wave of the bond market. From the size perspective, today we are at 53 lakh odd crores in corporate bond size. I am very bullish that it will reach 100 plus lakh crores, by 2030 or so, right? But I think it's not the size that is very interesting. Rather, it's the kind of change in investment for retail investors that will become interesting, right? So like I was mentioning that, today retail investor participation is pretty much on the lower side, just concentrated in some belts, right? This is going to increase, right? There will be monthly investments into bonds, which retail investors are going to do, right? And there will be people in the tier 3 and tier 4 cities very soon, wherein, an IFA, a mutual fund distributor, or even, a person who's selling insurance would also start offering bonds, right, to their neighborhood, to their friends and family for their investments. And that's something that I'm definitely, very bullish about.
Firstly, the example was very beautiful about the growth, and we hope to see that growth in the bond market as well.
Yeah.
So the demand for bond market will be as equal as the demand currently which we have for mutual fund.
Absolutely.
Yeah. So what's one misconception about bonds you would like to change?
Bonds are meant to be in an investment asset after retirement.
That's very interesting. So, Abhijit, from a retail investor perspective, as you rightly mentioned, awareness is there. People are becoming more aware and they want to invest in the bond market. But what about the risk? What are the risks they should consider before investing in the bond market?
I think that's a very, very pertinent question. And whenever I have the conversation, right, I always land up explaining this scenario, right? And it happened when I was speaking with my mom about her investment in bonds with a couple of friends in the earlier days, right, when they started investing, that what are the risks. And I think that's the right of every retail investor to know before they invest in this asset class, right? And let me put it in this way, like any asset class in the world, bonds also come with their own risks, right? What becomes important is to be aware of that and to take choices accordingly. So what's the first risk which is which is there for bonds? That is the risk of default, which means essentially the bond issuer has not paid on time or has not been able to return back the invested capital at all, right? That's one. The second risk is called the liquidity risk. Now in liquidity risk, the interesting thing is this is something which an investor creates for himself or herself. What do I mean by that? If you remain invested in a bond till it matures, you don't have liquidity risk. That's a wonderful thing about bonds. But in between, if an investor feels, hey, I need to sell off my bonds, I need to get my money back, right, and I need to get a good price for the bond, then getting a buyer, getting that right price might be a challenge at times, right? That's a liquidity risk.
So you mentioned about two risks. One is the default risk and the second is the liquidity risk.
Right.
Just to touch base on both of them. So first on the default risk, when a bond defaults, from an investor perspective, what is the amount? Because I'm putting my savings in that. So what is the amount which I'm going to get back?
Yeah, that's that's something that I get asked very frequently, right? And I think everybody in our company is especially the people who are interacting with customers, right? It's a very common question which comes in. And the thing is, over here there's a bit of a misconception or myth around default. And let me put it in this way. When people hear about default, they think that my whole money is gone. It's not true, right? In fact, SEBI has defined a framework which is sort of in the market parlance called as, day one, rupee one framework. What does that mean? SEBI says that if an issuer delays in payment, even for a single day, maybe because of some, unforeseen reasons, right? What essentially will happen is that company will be marked as a default. If the payment varies even by 1 rupee, that one will be marked as a default. So in reality, a default essentially does not mean that your money is lost. The money will come in one day after that. But companies know they cannot do that. We have that kind of a robust ecosystem, right, that safeguards retail investors. But having said that, it might be possible that a company actually has got some financial crisis because of which it's not being able to service the interest or being able to pay the money back. If that actually happens, then a series of regulatory steps unfold, right? All targeted towards recovering that money and paying back to the investors. One thing that I'll want to call out to investors is that you have to be very sure that you are investing in only listed bonds, because listed bonds are the ones which comes under SEBI's purview, and hence they have got those proper recovery and regulatory frameworks around them for safeguarding investors' money, right? There is no such official process of recovery for unlisted bonds default, right? Now, when the money is recovered, right, there is a waterfall mechanism in which people get their money back, the bondholders, and people should know that. And what is that? Secured bondholders get the money first, then followed by unsecured bondholders. So to, in a single line to answer your question, what happens to my money, right? It depends upon the default scenario and the kind of, situation that unfolds, right? That's essentially is how defaults are taken care of.
So as you mentioned, when a bond defaults, some portion of the amount, slowly and eventually the investor gets paid off. Is there a proportion which SEBI has defined, in which it gets paid off? So if I've invested 100 rupees, so will I be assured that my entire investment gets paid off or some portion of it gets paid off?
It once again depends upon the kind of defaults, right? So there have been defaults wherein the entire money has got paid off after a certain lag, but with even interest for that delay in payment, right? So investors have gotten back their money. There have been certain cases also, 5-6 years back, or slightly beyond that one, right, where there have been defaults, and certain portion has been recovered back and returned back to the investors, right?
So the key to this is investing in a listed bond,
Correct.
because SEBI protects the
Correct.
interest of the investors.
Absolutely.
And the second point on liquidity, which you mentioned, that if I want to liquidate my bond, so I need to find a buyer for my bond. When I mention I, is it I as a retailer, or is it I as a platform which helps me to find an investor?
Well, you see, liquidity is a structural problem in the bond market across the world, right? But then in our context, in GoldenPi's context, if I say, right, if investors want to liquidate their bonds, we help them in liquidating by buying it off into our books and give them that liquidity.
Similar to mutual funds, we will also have some lock-in or something around
There
this?
are no lock-in for bonds. Bonds are freely tradable assets. They are listed bonds are listed on the exchanges, right? Both BSE or NSE, right? Or both the exchanges.
So this will work exactly similar to the way equity works?
Well, the selling process, right, works a lot similar to that, right? But under the OBPP guidelines. So this is the kind of framework that SEBI has set up, for bond transactions, be it a buy transaction or a sell transaction. But yeah, for the retail investor, at the end of the day, it's a very seamless journey. The retail investor gets to, sell off his bonds and gets the money credited into his or her bank account in a very seamless digital way.
Thank you so much, Abhijit. Thank you so much for sharing such insightful details about the bond market and making us aware about the online bond platform providers. Thank you so much for having us. Thank you.
My pleasure.
The future of India's bond market will depend not just on the products, but also on participation. Thank you, Abhijit, for sharing your insight. And thank you, viewers, for watching. We will see you in the next episode of DebtCircle podcast.